You ever see a stock just fall off a cliff and think, man, I wish I saw that coming? Well, today we're going to do more than just wish. We are going to break down a precise, repeatable method for building a watch list of stocks that are screaming weakness long before they take a nosedive.
All right, welcome to AI Explains ICT. In this video, we're jumping headfirst into core content from month 10, episode 17, and it's all about how to hunt for stocks to sell. Now, this is a very specific step-by-step process, so you're probably going to want to grab a pen and paper for this one.
So here's the game plan. First up, we're going to lay the groundwork for building our sell watch list. Then we're going to zoom out and talk about timing, why seasonal tendencies are so critical. After that, we'll dive into the number one signal of institutional selling, and then I'll walk you through a simple two-filter process to pinpoint the absolute weakest stocks. And stick around, because we're going to see this play out in a real case study from 2015, and finally, we'll talk about why this all works. Okay, let's get into it. First things first, the foundation. This isn't about guesswork, and it's definitely not about throwing darts at a board and hoping for the best. The entire strategy comes down to one core idea: finding the weakest stocks at the exact moment the overall market is showing signs of rolling over. You know, the first rule of this whole method is patience. We don't just jump in whenever we feel like it. We wait. We wait for the market conditions to be absolutely perfect for sellers, and only then do we start building our watch list. See, this is all about precision, not trying to predict the future. Okay, now for the first ingredient in our recipe: timing. Because believe me, when you look for these setups is just as critical as what you're looking for. We're going to use historical patterns to tell us exactly when it's time to go on the hunt. So that begs the question, right? Is there a specific time of year when we should be on the lookout? A time when the deck is stacked in our favor for shorting? Does the market even have a predictable rhythm like that? And you bet there is. According to ICT, the answer is written right there in the 20-year seasonal patterns of the Dow Jones. As you can see from this chart, there's a period every single year where the market tends to be weak. We're talking about a specific window, from the beginning of May all the way to the end of July. That's our hunting season. Okay, so we've got our when, now we need the what. What's the signal? What's the market's big tell, kind of like in poker, that shows us the big institutions are secretly folding their hands and getting ready to sell? That signal has a name, SMT divergence, which stands for Smart Money Technique. Here's what it is in simple terms. It's when the big market indices, think the Dow and the NASDAQ, start to disagree. They're supposed to be buddies, moving together, right? But when one makes a new high and the other one just can't and fails to follow, that is a huge red flag. Take a look at this chart from 2015. This is a textbook example. See up top? The NASDAQ is pushing up, making a nice, new, higher high. But look below. The Dow and the S&P 500? No way. They're making lower highs. They just refuse to go along for the ride. And that right there? That's what ICT calls the fingerprint of institutional distribution. They're using that little bit of strength to quietly sell their positions. Okay, quick recap. We have our time of year, May to July. We have our big market signal, SMT divergence. Now it's time to get granular. We need to find the actual stocks to put on our watch list, the weakest links in the chain. And to do that, we use a simple two-filter process. This is really the heart of the whole thing. Filter number one: the big picture has to be bearish. We need that SMT divergence we just talked about. Check. Filter number two: now we look at individual stocks. And we're looking for one specific thing: a stock that makes a lower high when the index itself is making a higher high. That's the golden ticket. Now, to make our list even stronger, there are a few extra things to look for. We want stocks that are already looking weak on the weekly chart. You know, they're already in a downtrend. And hey, a word of advice: stay away from those super safe, slow-moving stocks like a Verizon or a Coke. They just don't move enough. We're hunting for clear, obvious, undeniable weakness. All right, enough theory. Let's see how this actually works in the real world. We're going to jump back to that 2015 sell-off and watch this pattern unfold step by step in some really big-name stocks. Okay, first up, American Express. The green line here is the Dow index, and the candles are the stock price. Now look closely. Between May and July, you see the Dow climbing, making higher highs. But what's AXP doing? The exact opposite. It's making lower highs. That's our signal, plain as day. And boom, look what happened next. A huge $30 drop. And it's not a one-off. Here's Caterpillar, Same story. The Dow is pushing higher into the summer, but CAT, it just can't keep up. It puts in that weaker lower high. And the result? An absolute monster of a decline, from almost $90 all the way down to 55. Next up, Chevron. Are you seeing the pattern yet? The Dow rallies, Chevron puts in a lower high. It's like a broken record. And just like the others, it led to a massive sell-off, falling from 110 all the way down to 70. And one more, ExxonMobil. I mean, by now, this pattern should be practically screaming at you. The Dow posts higher highs, but ExxonMobil fails to follow suit, showing that critical relative weakness. And that weakness was the last warning sign before the floor fell out. Okay, now here's a slightly different one, a bit of nuance for you. This is Walmart. It also showed the weakness and dropped for sure, but ICT points out it wasn't the best setup. Why? Because it was already just kind of drifting down. See, the absolute A-plus setup is a stock that tries to rally with the market and fails. It's that failure that's the real tell. We're looking to short a failed rally, not just jump on a moving train that's already headed down. So we've seen what to look for, and we've seen how to find it. Now for the big question. Why does this work? Why is it so reliable? Well, it all comes down to one thing: following the giant footprints of the smart money. And this quote from ICT really just says it all. If the program they're following leaves these types of footprints every year, then we know that we're onto something. See? It's not about guessing. It's about recognizing a pattern that happens over and over and over again. And that's really the key takeaway here. These huge institutions, they're so big, they can't hide what they're doing. Their massive buy and sell orders leave fingerprints all over the chart. So what we're doing here isn't some kind of magic trick. We're just learning to read the clues they leave behind. So there you have it, a systematic, step-by-step approach to building a sell watch list. Hey, if you got something out of this video, do me a favor and hit that like button, and be sure to subscribe so you don't miss the next one. Got any questions? Drop them in the comments below. I promise a real person will take a look and get back to you. Until next time, safe trading.